And so you just look at that from an objective standpoint. The less I have to put into a business as an owner or investor, the more valuable it is to me because it's going to run on its own.
Welcome to the Bold Brand Show. If you're in the AEC industry and want to grow your firm, we're sharing exactly how bold and innovative firms win more. The sad truth is, most firms that are struggling in the AEC industry are still doing things the way we've always done them. But this show is about finding a better way. I'm your host and founder of Bold Brand, Josh Miles. I'm a published author, veteran of the TEDx stage, and a brand strategist with over 25 years of experience. But my superpower is my focus on AEC firms to understand how branding and marketing in the professional services industries is wildly different than for retail brands like Apple, Amazon, or Starbucks. So in this podcast, we're going deep with AEC firm leaders, marketers, and innovators in the AEC industry. We'll focus on the hottest topics and trends in AEC to uncover the growth secrets of the most successful firms and how firms can create lasting legacies and perhaps what the future has in store. I've got a special deal to share with you from my friends at BizNow. I regularly hit up BizNow events here in Denver, and honestly, they're my go-to for networking in commercial real estate and AEC. Each month, they pull together these great panels with heavy-hitting speakers who actually know what's happening right now in different markets. Not just theory, but real deals and trends. What's cool is they're not just a Denver thing. They run these events across the country. So if you're looking to stay on top of market shifts or want to connect with people making moves in CRE, it's worth checking out. If you're interested, check out BizNow. That's biznow.com/events to see what's coming up. You can use the code BOLD, that's BOLD, when you register to save 15% on your ticket. Trust me, the connections you'll make are worth it. Special thank you to BizNow. Welcome back to another episode of the Bold Brand Show. I'm your host, Josh Miles. Today with me, we are chatting with Josh Lahre and Joe Smetona, co-founders and partners at AEC Advisors. Josh Lahre has spent his entire career dedicated to the AEC industry, advising clients on mergers and acquisitions, capitalization, internal stock valuation, and ownership transition issues. He's also a frequent keynote speaker at industry conferences, seminars, and webinars. Prior to AEC Advisors, Josh was a senior vice president at EFCG, where he'd worked for 11 years. He graduated from Harvard University and played varsity soccer. Joe Smetona, throughout Joe's career, he's focused on corporate finance, investment analysis, mergers and acquisitions, and financial sponsor advisory. Prior to AEC Advisors, Joe worked in several corporate finance advisory and investing roles, including as a vice president at EFCG, an investment associate at a family office, and a capital markets analyst at CIT Group. Joe graduated from Columbia University with an MS in Operations Research and Case Western University with a BSc in Mechanical Engineering and a BA in Philosophy. He was also the varsity captain of the Case Western tennis team. And for the sake of full disclosure, I've had the pleasure of working with the AEC Advisors team for the past few years on various video and photography projects, and they just happen to be one of my favorite companies in the industry. Great to see you guys both. Welcome to the Bold Brand Show.
Thanks for having us, Josh.
Thank you.
Yeah, the two things I learned from you guys when I started doing headshots for you was one, it seemed like everybody there was an athlete and everybody there was attractive.
Don't make us embarrassed. Start.
No comment.
Get you blushing right out of the gates.
Yeah.
Well, one of my favorite things to do on this show, everybody we talk to is sort of involved and deeply in the AEC industry, but we like to go deep on topics and kind of focus and concentrate around your areas of expertise. Specifically, we want to talk about corporate finance and M&A activity with you guys, of course. And we had your friend Bjorn on the show previously speaking about M&A over at Stantec. So for listeners who haven't caught up to that episode yet, we will definitely link that in the show notes. And if you're watching on YouTube, it's going to be, that link up there, whatever side that's on. But today, looking at the industry a little more broadly than just what's happening at Stantec, maybe for firms who are like, I am never going to sell, why should they keep listening? Joe, I think this one's directed to you. Or no, Josh, this one's directed to you.
was gonna say if they're watching, I think Joe's flow is enough for anyone to keep listening or watching. But in all
But
ser-
not my nasal voice.
in all seriousness, I think one of the things we want to talk about today, Josh, or we're going to cover is that creating value and what makes firms valuable is the same whether they're planning to sell or never sell. A lot of value creation is basically the same for those that are looking to transition internally and don't have plans to sell. But what makes them valuable internally also makes them valuable from M&A perspective.
Joe, anything you want to add to that?
No, I would agree. At the end of the day, I think if you're a business owner, you also want to have optionality. You may say today, I don't want to sell, but you never know in the future, 5, 10, 15, 20 years down the road. Perhaps your partners have retired. Perhaps you're alone at the top and don't have an ownership transition plan. You don't know how those things are going to play out. And it seems to me that you always want to be in a place where you've got options, even if you don't plan to sell.
Well, the exact words I think I said about my first agency that I sold after 16 years was prior to that, I said, you will have to pry it from my cold, dead hands. But life happened and things changed. And so I found myself in a position to sell to a partner. And so that worked out well for me. But specifically, we want to talk today about why M&A has been so hot and continues to be so important in the AEC industries. And from the looks of things, nothing's slowing down. Joe, what's going on there?
So there's a lot to say about that, but I would say historically there's been a lot of M&A activity in the AEC space, so that's not really new. But it kind of got turbocharged really over the last 5 years as private equity came into the industry in a big way. I think in many ways the industry's always been providing sort of critical services to society, but it kind of got glossed over in the newspapers and the headlines, and people were more focused on tech and other, sexier industries. But I think in 2020, when we passed the $1 trillion Infrastructure Act, that brought a ton of attention to our space, and people started saying, whoa, what's going on here? And then that was followed up with the whole ESG and environmental movement with increasing awareness around climate change. And then more recently, the whole energy transition challenge, right? AI, electric vehicles, crypto, that all requires huge amounts of energy generation and transmission. So I think those macro themes convinced people that this is an industry that's going to grow a lot faster than GDP and probably have less volatility than GDP. And that brought a lot of attention to the space. And I think the other things I would say is investors came to realize that these businesses make money, they're profitable. It's not a technology business that you have to invest in for 10 years. They're services businesses that are profitable pretty much, after the first couple of years. It's a very fragmented market. So if you buy one, there's a lot of things that you can add on to sort of accelerate the growth in your business. And there's a lot of baby boomers and aging owners who kind of are at the helm of these businesses and will need to transition ownership either internally to their partners or externally via sale. So I think those are just a few of the reasons that M&A has really sort of accelerated over the last 5 years.
I might add, Joe, thinking about it, Joe, that you mentioned private equity or financial sponsors more or less flooding the industry. I guess from our perspective, it's a whole new form of ownership structure that really wasn't available except for a select few, even as recent as a decade or two ago. So I think we look at it as private equity in general has just offered up a new avenue for ownership in the industry that really wasn't available to most. So that alone has created more M&A, and through the recapitalization events that those private equity groups go through is going to create naturally more M&A activity as well.
I think one of the most challenging things, at least in my mind, is how you would go about valuing a firm. So if you're wanting to explore selling your firm or figuring out like what's my firm even worth, where would you start?
Sure, and I'll take a crack at that. I'll use an analogy. So if you're selling your house, how do you value the house? You typically look at what other homes in your neighborhood sold for, and you come up with some price per square foot. And that's what your home is likely going to be worth. You look and you say, is it a little nicer? Is it a better view? Is it more modern, etc.? And so for engineering businesses, instead of square feet, it's really earnings. And the key earnings metric that buyers and investors look at is something called EBITDA. And so really these businesses are valued on a multiple of EBITDA, and the multiple will depend on things like how fast they're growing, how profitable they are, just like a home, what geography you're located in. If you're in an attractive geography, you're worth more. the quality of the leadership, how attractive their clients are, how diversified their clients are, these types of things. So the better quality business will get a higher multiple of earnings than a lower quality business or a smaller, sort of less developed business. But that's the key way that businesses are really valued. And they really look at what you've done over the last few years and what you're currently doing. Certainly people look to the future, but at the end of the day, these are project-based businesses. It's hard to really know how much earnings you're going to generate a couple years out. So people really tend to value them based on what you've done sort of recently versus what you kind of say you may do.
Josh, anything you want to add to that?
I mean, I would add, it sort of parlays into the next section here about creating value and how firms can create that value. And I really want to emphasize something Joe was saying about the home example. We use that a lot. And we always talk about investing in that home, investing in for the future so that it can scale and grow with maybe your family is a good analogy. And so when you look at businesses and we think about just from the highest level, firms that are the most valuable, in my opinion, are those that can basically run on their own. They stand alone. They're they are going to be able to grow and scale without much investment or very little investment. And so you just look at that from an objective standpoint. The less I have to put into a business as an owner or investor, the more valuable it is to me because it's going to run on its own. So anyone looking at their business saying, well, how do I create value? You need to create leadership succession. You need to have a succession plan and a deep leadership bench. It can't be just one or two people driving that business. That thing needs to be able to run on its own. And you need to have proper systems in place, right? Make sure you've got the systems to scale. We so often run into business owners that are running their business on a shoestring, and they come to us and say, I'm ready to sell, but I haven't invested in finance. I have no ERP or back office systems whatsoever, and I want to sell for top dollar. And the short answer is you can't. Because as soon as someone looks at your business, they're going to look at all the things they're going to need to put into it. And so, using that home example again, that owner put all their money and just threw it up in the attic, right? They just buried their money in the backyard. They didn't invest in the new kitchen. They didn't invest in everything. They didn't make that home more valuable. So either you invest now and do the hard work and make yourself more valuable, or someone else is going to do it. And they're going to pay you less today because they got to put more in tomorrow.
What are the most important levers that principals can pull outside of finances?
Yeah, I guess I touched on it there. It's almost shocking every time we do a deal and you realize just how important leadership really is. The people at the top matter so much, and maybe we shouldn't be surprised because these are people, asset businesses, right? Professional services. And at the end of the day, it's a relationship driven business, and clients hire people, they don't hire the firm. So it comes down to how deep do those client relationships go, how much IP exists across that company, right? How maybe how educators are these individuals, how much skill do they bring to the table? But really, when you sit down with a group and you recognize they have 2 or 3 generations of leadership behind them, that's got to be the first and foremost, the absolute most important thing. Frankly, the numbers tend to follow that kind of situation. So I would say leadership and people would be my answer. I don't know about you, Joe.
No, I agree. I mean, at the end of the day, what are you buying? You're buying people. And who are the most important people? The people that run the business. And I think the only other thing I would add is at a most basic level, if you want to get a higher value for your firm, you have to be growing because that's how you provide a quicker return to the investor. And you have to reduce risk. People pay a higher price when there's less risk. So what are the biggest risk factors? Key man, key woman risk. One person at the top holds all the relationships, hasn't transitioned them. That's something we find a lot. And it may be great for that person while they run the business, but if you're going to get a wheelbarrow full of money, people are going to be worried that you're going to go off to the sun and that sunset, and there's no one there to replace you and to continue to mine those relationships. So building up those successors is just critical to reducing risk in the business. And then I would add, like, not being too dependent on any one client. It's easy to grow with a client, and then you milk that client. You've got a great relationship. They give you sole source work. But if one client's half your revenue or 30% of your revenue, a buyer's always going to look at that and say, so what happens if we lose that client? We lose 30, 40, 50% of our business. That's a big challenge.
Yeah, you said it. I was just as you were talking, I was thinking, what are the things that like blow up process for us? We go out to market and people say, "Yeah, it looks like a great business, but I'm going to pass." It's the leadership, right? It's the risk associated with the business itself, what they're doing, and or client concentration. Those have got to be the three largest factors why people pass on what would otherwise be a great business.
Joe, tell us a little bit about your role in the M&A process and how AEC Advisors does things differently.
Sure. So I think a couple things. One is AEC Advisors, we're very focused. I know you help a lot on our website, and that's one of our sort of core values. We just focus on this space. We like to know it sort of inside out and hopefully better than any other advisor. So I think that's the first difference. And the other thing I would say is that we provide sort of, full service from the second you engage us to when you actually close your transaction and a wire comes across. We're there, we're helping you prep, we're holding your hand. We're negotiating for you. We're working through diligence. We're not just someone who opens the door and sets you up with some other focus. We help prep your business. We point out the things that you need to address. We position it in the best possible light. Then I think we've got a pretty unique sort of insight into who would like to buy or partner with you, just given that we live in this space exclusively. And then we're there to sort of guide you all the way through diligence, both from a negotiating perspective, but also there's a heavy lift. If you've never been through this process, people are going to ask for every document imaginable that you didn't even know you had, to pull all sorts of reports and go through all ads. And we'll have all sorts of questions. And I think we can help sort of parry a lot of those to make your life easier in what's a stressful process. And ultimately, I think that helps you get the best outcome in the most efficient way possible.
I'm having PTSD to being a small business owner and applying for a mortgage. I'm picturing the stack being about
And
10x of
this is
that.
like 10 times worse, right?
Right.
Because with a mortgage, they have a security, which is your property. When they buy your business, there is no security.
I mean, I'd like to say we also have a good team, Joe. I mean, talk
Yes.
about going back to the whole people thing. We're very biased, but we have an excellent team where, and we do hear this. I think what differentiates is beyond this the most senior folks in the company, the team behind us really steps up and handles the client interactions very well. They're mature. We kind of have tried to live what we preach to our clients, that we need to have a deep bench behind us as well. And frankly, the goal is that you're not calling Josh or Joe or Andre or Tyler. You're calling everybody at the company, and frankly, stop calling us. So we're trying to make ourselves irrelevant is what we're trying to do.
And we want to
And
bring a whole team. When we get an assignment, we normally have 4 to 6 people on that assignment. So you've got a lot of redundancy. No matter what time you have a question, we're there. If someone's on a plane flight or traveling, you're covered.
do you guys have a preference for working with sellers versus buyers, or is it pretty evenly mixed?
We like sellers because there's a much higher likelihood of success. When you engage on the sales side, it's nice because that company has decided that they would like to pursue a sale, and it's much more likely that there's going to be a successful outcome. Not that we don't like working with buyers; they're perfectly fine people, but you're normally one of 10 or 20 or more, and so your odds are much lower. So we have tried to focus a bit more on the sell side, as I'm sure most bankers would love to. But we are very selective on the buy side and work with groups in certain processes.
And I would also add that it's a very meaningful thing when you are working with a business owner who founded a business 20, 30, 40 years ago, spent their whole life working on that business and building it. When they ultimately go to sell it and find a partner, it's deeply personal and emotional. I think you build a close relationship with that founder, and at some level, you're changing their and their family's lives and hopefully finding a great home for the people too. So I find it's not that it's not impactful working with buyers too, but it's a really, really impactful working with sellers.
Josh, I've heard you talk about professionalizing your business. So if I'm a firm principal and want to further professionalize my business, what would that entail?
Yeah, we sort of alluded to it earlier when you think about the internal operations of the business, and we think about that in terms of you normally have like a finance function, an HR function. You probably have some sort of legal counsel, either internal or external, and really beyond the sort of human roles, you're also going to need to have certain systems in place. In our industry, they have ERP systems and you frankly have some sort of accounting software as well to help your finance team. The more systems like that you have in place, obviously, the more scalable your business is and the more quote unquote professional you are. And once again, going back to what we keep talking about, whether you're going to sell internally or externally, the business has to be positioned to grow, has to be positioned to scale. And whether you need a CFO today, you may not, but having a controller or some sort of individual that's working in the finance department is a good first step. So we think about it as what are the day-to-day operations or functions within an organization that you need to basically function, right? To operate, and you need to go and invest in those and professionalize that business. Beyond that, there's something that you taught us, and David LaCour has taught us too, is you also need to professionalize the way you present yourself to clients, to markets, to customers, and to potential employees and staff. And that was pretty lost on us until we met you all. This is maybe an infomercial for you guys, but you really helped us appreciate we need to first and foremost sit down and truly recognize who we are as a company, what's our mission, vision, values, what does our brand stand for, which was one of the most interesting and insightful processes we've ever gone through. And then once we define that, we defined our brand, our logo, our color scheme, and everything. We need to live and breathe that every single day. And I know I sent you an email this week that we put together our first handbook ever as a company. And it took a really long time and it was super painful, but I'm really proud of it. The
Mm.
team did such a good job on it. And when I read that, it's this like living document about who we are. And to me, that's very professional, right? I think about if you join an organization like you join Goldman Sachs, they're going to hand you this info about here's the things we do, here's who we are, and go read this book and do that. And as a small business, we just didn't have that. But now I'm recognizing, or we are recognizing, that part of our professionalization as a company is doing those type of things.
Yeah, historically, so many firms have um, had to memorialize their mission or vision or values and hang it on the wall because it was so unremarkable. Nobody could remember what it was. So forgettable, like sounds like everybody else. But when you do the hard work to really figure out, wait, why are we different and how do we want to be seen by our uh, employees as well as our clients?
Yeah.
And then to really live that out and to commit to it. And as you said, to actually start creating those documents and memorializing those things in a way that's like this is real and it's something to be really proud of.
Yeah, I agree. As you know, we've got them written on our pillars out here. They're literally written on physical pillars. Um, so it's anyway. I think that sometimes that gets lost too. People think go out there and make money, but people need to want to join a real organization, and clients need to be able to identify with who you are, what makes you different.
And I'll sort of add two things that when people talk about professionalization, I think sometimes small business owners run everything by feel, right? They're close to the clients, they're close to the projects, and they're sort of head, they know what's going on, they have a sense for it, but that's not scalable when you get to a certain size. And if you're a buyer or investor, you're not inside the owner's head. You don't have access to that repository of information. If you can't see it in data on a piece of paper, you don't know it, and you can't manage that which you can't measure. And
Mm.
then as to the people part, I think sometimes, small business owners or large business owners kind of think it's all about them. I'm the owner, I own the business. But if you're not really investing in your people and you're not creating a business of the people for the people, that's not going to be scalable long term either. It's just kind of going to be your pet project. It's more of a practice area and you're a practice lead versus building a real business that's scalable that someone else actually wants to pay you a lot of money for.
Joe, maybe as a segue to that, if we think about what buyers are looking for today for firms that they want to be acquired, that they want to acquire, what are some of the qualities that are most important to buyers right now?
Sure. So I think there's two things. One is buyers normally want to fill holes. So they could just buy more to get more mass, and that's okay, but it's less interesting to them. For example, if a firm is, an East Coast firm that doesn't have a presence in Georgia and as a whole there, they're going to be a lot more interested in buying a business that's in Georgia than buying a business that does a little bit everywhere. So I think in general, if you're a seller and you have a business that's an expert in a certain area, whether it's a market, a service line, a geography, I think that's going to be viewed attractively by buyers. I think the second thing that buyers look for is it goes back to some of the points you mentioned earlier. They look for leadership. If the CEO is 67, 68 years old and has no successors, I'm not trying to sound ageist, but that's not real attractive. If the same CEO has five people in their 40s and 50s who have 10, 15-year horizon to run and build a business, that's much more attractive to a buyer. So it comes back to that people thing. And then I think the other thing is people want businesses that are respected. They want to be able to call your customers and hear this business is best in class. They do great work. They're a high quality firm. So I know we tend to focus a lot on the financials, and certainly the financials are important and play a big role in the price. But being someone who's respected in your market, who has a brand that's attractive, a brand that can recruit, something that a buyer can leverage, that's important too.
Josh, anything that you'd add to that list?
No, I was going to add the market leader concept and brand leader. So I think Joe nailed it.
Josh, you touched on this a little bit before, but I wonder if there's anything else that kind of tends to be the derailing factor in a sale. You know, what are some of those things that and I guess it goes both ways. What are some things that buyers last second are like, okay, no, thank you, or that even sellers something that would stop the deal from getting done?
Yeah, there's a couple key things I guess you could say that derail a process where you're kind of signed and you're in exclusivity and you're looking to close, which by the way is very rare. But in the few instances that I've been involved with that happened is the two parties actually never really fully trusted one another.
Hmm.
Right? They sort of signed an agreement and they might have been pursuing that deal for the wrong reasons. Price normally is the wrong reason, saying, well, this was the highest price, but they never felt totally comfortable with the other side for whatever reason. A lot of times it's just cultural misalignment. It's not that they're bad actors, it's just they're just culturally misaligned. And so you're going through this diligence period where we like to say, before you sign a letter of intent to close a deal, you talk about all the reasons why you love each other and you want to do the deal. And the moment you sign that, you try to find all the reasons not to do the deal. And so that kind of confirmatory diligence period to close is very painful and sometimes almost offensive to the seller because they say, well, wait a second, I thought you loved me. I thought you wanted to merge our two entities. And the answer is they do, but they have investors, they have shareholders, they have legal counsel, they have all these groups that are saying you need to vet everything. So they're trying to poke holes in it. And that's where if you don't really trust one another and you're not totally culturally aligned, those fissures just they become, I mean, massive, canyons,
Hmm.
and the deal falls apart. So I would say that's probably the biggest reason on either side is you're just pursuing the deal for the wrong reason, and the buyer is unwilling to admit that, so they're allowing the deal to go forward, and the seller is lying to his or herself that this will the money will make up for it. Which I want to sort of a bit of a segue into what I was also going to say is we also have this talk about what happens why deals fail post close, because there's
Hmm.
deals that are unsuccessful after they've closed, and there's obviously a variety of reasons why that happens. And normally you assess a quote failed M&A in this industry when people leave. The key people leave quickly after the deal closes. That would be a failed transaction. And we, in our experience, that normally has a lot to do with the fact that there's a failed integration. There wasn't a lot of focus on once the deal closed, how do we make this firm fit into our organization? And frankly, integration should be starting prior to the closing of a transaction. You should already get that going and figuring
Hmm.
out these leaders fit into these spots, these people fit in over here, and strategically, here's how our businesses fit together. As opposed to, again, haggling over price and a dollar here, a dollar there. Another kind of one of these cliched sayings we have at AEC Advisors is no one has, and it's actually true, no one has ever come back to us after a transaction closed and said, if I paid $1 million less, it would have been a great deal. Kind of the deal is a good deal at any price because when a deal is successful, the growth is exponential, the synergies are all there, and basically it pays for itself in time. The other side of it is, though, the deal is a bad price at any price because it becomes damaging, not just financially, but morale wise. You just think about it's like, basically a body not accepting a cadaver entity, right? It's sort of rejecting it. that is just what happens. And the rest of that body ends up feeling down. And frankly, you can hurt the morale of your existing business. So we talk about price, but that integration is so critical. And it's actually not as common as you'd think in our space where buyers are super good at integration. There's several. You mentioned
Hmm.
Bjorn, I'll give him a shout out. They're wonderful at it, and they're some of the most thoughtful people out there. But not everyone is as thoughtful as they are.
Yeah, I mean, he talked about how intentional they are about being better together, and that it is the intention that if we acquire you, if you become part of Stantec, you will be Stantec within the year, sometimes less. And I know I've heard lots of other buyers that have a, well, we'll figure it out and see mentality, which is sort of the opposite of like, maybe we'll keep their brand, maybe we won't, maybe we'll change their name, maybe we'll be a family company of this or that. And it's tough for everybody when there's kind of that gray area that the employees don't know, your current clients don't know, their current clients don't know. It makes it really tricky. So um, again, I thought it was really interesting how intentional they are about this is part of the deal. Like this is part of the vetting process to see if this is even going to work.
And two things I'd add is if you're a seller, where I've seen deals fall apart is that there's not alignment in the partnership group. Maybe it's the CEO or one or two partners who quickly pushes for sale and they think they have alignment. And sometimes a month or two into the process or at the very end, they find out, oh boy, actually my partners weren't on board. So I think if you're a privately held business that's got a number of partners, don't assume you're all on the same page. You need to take the time to build consensus, get everyone aligned before you go to a process rather than getting down to the altar with someone and then hoping that everyone's going to come on board. I think these conversations are tough and they can be awkward and people are worried about confidentiality. So it's easy to kick the can down the road, but that's definitely critical. And I think the other thing I've seen blow up deals is where people don't hit their numbers. Selling your business is very distracting, both time wise, emotionally. You're meeting with folks, you're trying to prep all this diligence, and it's easy to take your eye off the ball in the business. And you have a few bad months right before closing, and you were selling off of X dollars of earnings, and now you're at 0.7x. Well, most of the buyers are going to say, hey, you told me you have X, and now you give me zero point 0.7. Well, guess what? The price is now zero point 0.7 and that tends not to go over very well. So see, those are just two other things to keep in mind as a seller.
Joe, would you suggest in your experience that M&A is a good strategy only for larger firms, or could firms at any size succeed with that path?
I think firms of all sizes can succeed with M&A, but there's a couple important sort of variables. One is your capitalization. So a mid-sized firm that has outside capital or investor and a big pile of money is probably going to be better positioned to acquire businesses than a firm that may be much larger, but maybe they're employee owned and they're spending most of their cash flows to sort of buy out former partners. So that's sort of variable number one. And then I think the second variable is that if you're a smaller firm that does not have outside capital, you have to have a strategy at M&A. You can't expect to just go to an auction and compete with Bjorn at Stantec and a bunch of private equity investors. You're probably not going to be able to win. And once a firm goes to auction, price tends to be pretty close to the gating sort of metric. So I think if you're a smaller business, you have to really look to sort of build relationships with sellers. And quite frankly, that applies to larger businesses too, but maybe particularly smaller ones ahead of a process. So you already have your foot in the door, you've gotten to know them, you've built a relationship. When a seller's selling their business, they're effectively giving away their baby. They're kind of getting married. And you either need to be the best partner for them or you better show up with a wheelbarrow full of money. So I think if you're a smaller business, really focusing on that cultural fit and building the relationship, getting to know them, showing that you care, showing them how they could fit into the organization is really important. And I think the other thing is that while a small firm may not be able to offer as much money, they can sometimes offer a lot more leadership, autonomy, and a more important role in the organization. And we found that one of the most important things that a buyer can provide, in addition to money, is that leadership and autonomy. Most firms don't want to sell and just become a cog in the proverbial machine. They want to feel like we still have an important role. We were a CEO, we were COO, we were CFO. We don't want to just be a middle manager. Show us a role. Maybe we lead a certain division or geography or have some other sort of important role in the firm where we still feel that sense of we're accomplishing something and we're not just buried in the bureaucracy. I think that's something that small firms can excel at just because there's more white space on the page for them.
Yeah, I wanted to underline that autonomy comment, Joe. We helped Terry Rule, the CEO of Lochner, do actually like a thesis on M&A and success. And through all the research he did, I remember he found that autonomy is what made people the happiest in a transaction. And money is fleeting. You know, we always say 6 months after the deal, people forget all about that money, and they go back to what does my day to day look like? What does my life look like? And if they suddenly have all these new overlords telling them what to do, their life is generally worse off. And so the price of autonomy is frankly priceless. And I do totally agree. Smaller firms can offer that because you're joining an organization, you're a larger piece of the puzzle, and they really need you to step up and lead something that either they don't have or it's fledgling. So I think autonomy is just probably the smaller firm's calling card in M&A.
Joe, I've appreciated that you guys really are thought leaders in this space, and the conferences and the webinars that you've held really do a great job of exposing kind of what's happening right now. So what is happening right now? What trends are you seeing in 2025?
I think at a high level, there's certainly macroeconomic concerns. There's the whole tariff tantrum over the last couple of months that everyone's been following. People are worried about interest rates. People are worried about us heading into a recession. So I think that there's certainly some concerns out there. But maybe the part that's surprising is that I think the AEC space largely is sort of a safe haven for investors and buyers who may be worried about those trends. If you think about it, tariffs tend to impact products businesses much more. If you're a manufacturer or you're a clothing retailer and you buy products from China, Vietnam, Europe, another country, you're going to be far more impacted by tariffs than someone who's selling a service in the US. So I think that given that our clients are services businesses, I think there's maybe been by investors a bit of a flight to quality towards services businesses. And then within the whole services businesses world, a lot of what the AEC does is sort of mission critical. It's transportation. We can't have bridges failing. It's water. We need clean water, clean air, power to fund the latest sort of AI innovation. So I think it's not that the tariffs necessarily are making engineering firms more successful. It's more, I think, highlighting how this industry is a sort of a place of resiliency in a world that's otherwise a little bit more chaotic.
For me, everything sort of comes back to branding. As a side point, I think working with firms through a merger or some other type of ownership transition is really the most rewarding kind of branding projects that we can work on, because those clients, those businesses are so engaged because they understand how mission critical it is, versus somebody who's like, I'm just going to update my colors and do a different thing here. But I'm curious what the role that you see for sellers, what that brand value is, and how that can also impact the deal.
Yeah, it's a good question. It's interesting because certainly in the early or middle part of a deal, it feels like sometimes brand, your logo, is one of the most important issues to a seller, and they talk a lot about it. And with a lot of these firms, there's a really strong legacy there, and it is important. Um, Less so for the reasons they might tell you, because I think it's more personal and emotional to the individual. That part I think is maybe a bit of a red herring, but where it is true and valuable is clients, their clients, the market. When they go out, they're getting hired as ABC company, and as I just said, that matters. In talking on the other side of my mouth, I did say earlier, people hire people. And so you kind of get a little bit over your skis and recognize that you have a personal brand that matters as well in the market. But that said, firms' legacy and history matter a heck of a lot, especially if you've been around for 100 plus years, which some of our clients have. And so you can't just get rid of that brand or that logo, let's say, on day one. And so that part, again, is something that a good buyer, a thoughtful buyer, really has an approach that they take. And you mentioned that Bjorn's at Stantec. Well, within a year, you're going to integrate into the Stantec brand. they may say that, but they have a very thoughtful approach, and they work with that seller in terms of the timing of it, and where it, and when and how, I should say, the communication with the seller's clients will be that, okay, we're now going to transition to Stantec or ABC company, but we're still here. We're still here to serve you. And so it's that communication that's absolutely critical, that I think sellers have a lot of heartburn over, but we rarely hear them come back and say, I lost a bunch of clients because I sold to such and such. Frankly, you should be able to assess that before you sign a deal with the firm, right? You should be able to get
Right.
through all that. Um, the final thing I'll say, that again, kind of these stories, the anecdotes that we get in all the deals that we work on, is more often than not, a seller actually comes back to the buyer before the designated date and says, I'd like to transition to the brand sooner, because it turns out that my brand has a certain cachet, but yours has a different cachet as well. And I recognize that they still want to work with me, Josh or Joe or Josh, but the bigger brand, normally the larger brand, the more global brand, actually is helping me out. Like I'm noticing I might get more calls, or it might actually give me I might have a different type of cachet. And so it's not like you're losing your brand, it's additive. And I can't tell you how many buyers have told us, yeah, they came back to us within a couple months and said, turns out we actually want your brand, and we're ready for the transition now. So a bit of a reversal in terms of where you think that one's going.
And two other things I would add is branding also matters as a buyer. Your reputation in the market as a buyer and acquirer is really, really important. When we sit down with our clients and we go through a list of firms that we say, hey, maybe we should approach X number of firms, and here are the names, and we think they could be good partners, I think you'd be surprised how strong of feelings a lot of sellers have. So if you're someone who wants to be doing acquisitions and you want to be out there in the market, you need to really protect your brand, and you need to make sure that people are happy after you've acquired them, that you're holding on to your people, that these deals are successful. And when people leave, they have a relatively good taste in their mouth, because it's a small industry. People talk. And if your brand as a buyer goes south, folks aren't going to want to sell to you, and you'll never really know why. You just keep losing in processes. What's going on? Why do I keep losing? I'm offering a fair price. The problem may be that your brand may need a little bit of an upgrade as a buyer, and it's not an easy thing to change, but it's something I think you need to be very, very sensitive to, because it's easy to cause brand damage and it's hard to fix it. I think the other thing is, when Josh was talking about integration, um, I think a lot of sellers are very worried that after they sell their business, their clients are going to get spooked, right? When you call the clients and you say, gee, I'm no longer XYZ company, I'm Stantec, the clients are going to say, oh, gee, I'm going to fire you. I don't want you anymore. What I think they don't realize is that most of the time the clients are going to look at it and say, I still have the same person servicing my account that I've always worked for and liked, but I now have fixed the problem, is that person couldn't work for me in all these geographies, or they didn't provide these other services. So now I have the resources of a much larger firm behind them with the same personal touch that I've come to know, trust, and love before. That actually becomes a pretty easy pitch. So I think it's something that I find sellers get very, very anxious about, of breaking the news to their clients. But it's normally not a big issue at all. Just like the changing of branding is something that I think a lot of them fear more than they really should be afraid of.
It's probably a sign that you chose the right partner. You're doing the right deal when you go to your clients and say, I'm changing, we're changing, we're merging with this entity, we're going to change brands eventually. And the client actually gets excited and says, you know what, this is great news. First, you're going to keep working for me? Yeah, I'll still be here. Oh, want to get all this other stuff? Wonderful. Um, if that's the response, then you probably made the right decision.
Josh, what would you say the impacts are of the work that you're doing for the next generation of leadership for your clients?
Oh boy. Uh, it's a heavy hitting question. Um, what I think, because we also do the consulting work too. I'm thinking about what do we do on all fronts that are helping the next generation. Um, I'll go back to right. Our mission is to make this the most valuable industry in the world. Um, so I truly think that the work that we're doing, and others like us are doing in this industry, will hopefully make the next generation smarter, more aware of the options that are out there in terms of the value creation they can have internally or externally. Um, but also, I think that it's it's our job to make the rest of the world appreciate just how valuable the services are that AEC firms provide to the natural built environment. So, how are we impacting them? We're probably hopefully putting a brighter spotlight on them, making the world, the outside world, more aware of it. That may make things more valuable internally and externally, I think is our goal. But uh, I'm hoping that the next generation of leadership is more appreciated than the one before them for what they do.
Joe, how would you say AEC Advisors is standing out and trying to differentiate in the market?
I would say I'd go back to some of the things I mentioned before. I think we're focused. We're a pure play advisory business only focused on the AEC space. I think that just enables us to be more effective, to be more knowledgeable. And our clients, they're our bread and butter. We don't work in a bunch of other industries where we spread our attention and sort of effort across it. And the other thing, it also puts pressure on us. We can't hide. Everyone in this industry knows each other. We have to do a good work. We have to treasure our reputation because word gets around quickly if we don't do a good job. And I think so far we've managed to maintain a good reputation. So I'd say that pure play AEC focus, I think that's one. The second thing is our many of our bread and butter clients are sort of mid-sized firms. They could have 100, 200, 500,000 people. That's very much our core sort of clientele. And what we've done is try to build out a very impressive team that's got expertise from big banks like the Goldman Sachs, the Bank of Americas, the Guggenheims, the Perel Weinbergs, the Jeffries, et cetera, and to bring that sort of large firm competence, expertise, and training to sort of the middle market, privately held businesses that are our core clients. And I think that's something that differentiates us from a lot of our smaller competitors that we sort of invested in and brought in a lot of sort of top talent to be able to bring that, to bear, even if a client is more of a mid-sized client, but still wants, best in class advice and service.
Is there anything that you guys are doing differently this year from a marketing and business development standpoint that seems to really be standing out or gaining traction?
I would say two things. Josh mentioned professionalization of our clients, and we're also trying to professionalize our own business. So I think from a marketing perspective, it's a little bit less about just hustling and calling people and staying in front of people. We're trying to do it in a more focused, comprehensive manner, just part of that scaling our own business that I think is important. And then the other thing I would say is we're in a personal business. When sellers make a decision to hire an advisor to sell, it's one of the most sort of important business decisions they're going to make. This is something they spent 10, 20, 30, 40 years building. And it's quite frankly most of the retirement savings in many cases. So the gravity of that decision is not lost on us. And I think that we're trying to spend even more time developing those relationships, earning the trust, getting out, spending time with people sort of in person. I think those are sort of the two things that we're really focused on. And I would say the third is just continuing to help the team beneath us, right? It's not just about the four partners at the top of the business, but the next generation, helping them sort of develop their own relationships and participate more in the marketing efforts in order us to, better serve our clients and selfishly scale our own business too.
Josh, I've said many times on this show in particular, and probably lost count otherwise, that video is sort of a cheat code for an industry that tends to hire people that they know, like, and trust. I think it's incredible too for conveying culture. So I'm curious, how many of your buyers are looking at the seller's corporate video, and like, is that a way for them to get a sample or a taste, or are you seeing any of your clients using video differently?
I think so. I think the answer is yes, more or less across the board. First, I think about just what we do when we get hired. We go straight to the firm's website and try to watch videos, see who's talking. It's just the the CEO up there talking and nobody else. It tells you a lot about that organization, right? And you want to see who else is on there and the topics they're speaking on. So I can only imagine that buyers are doing the same exact thing. Uh, what are the first few words out of their mouth? What are they focused on? Again, who's in that video? That probably tells them more than anything else about the culture of that firm. So it's interesting. We haven't had that explicit conversation with our clients, but I know if we're doing it, I have to assume they're doing it, and vice versa. Sellers will do the same thing to the buyer, trying to figure out who they are and what do they really value.
Joe, what would you like to see AEC or advisors do differently, or perhaps the industry on the whole? What are some things that you'd like to see change?
Well, I think that there's been a lot of positive change in the industry recently. I think historically engineers were undervalued, and that's part of our mission is to help them sort of recoup some of the value that they provided to society. They're paid much lower than most other professionals. You think about attorneys, doctors, accountants, investment bankers, management consultants. They're all paid far, far, far more than engineers. I think finally that's starting to change, not necessarily that engineers' salaries have gone up that much, although they are going up, but more that people, the partners of these firms, are finally getting paid in the form of a sales price because people realize these are really valuable businesses. They're going to be around as long as sort of humans are around. They're providing sort of mission critical services to society, making sure we drink clean water, have safe roads, can have energy to turn our lights on. What's really more important than that? So I think that there's starting to be a realization of that, but we certainly want that to continue, and engineers to continue to hopefully, close the sort of pay parity gap with other professionals. And I think that's important also for the industry to recruit talent. I think we're solving some of the biggest challenges in society. You think about things like climate change. I mean, it's just huge challenges that aren't going to be easy to solve. And to solve it, like clearly, we have to continue to recruit more talent. I find a lot of CEOs, they say, Joe and Josh, the work is out there, the opportunities are out there, the workers aren't. So we're hoping that all these sort of new attention and positive changes to the industry will help it recruit sort of the best and the brightest, which I think is beneficial for all of us long term. So I'm hoping that will certainly continue. And I think AI also could play a big role. As I said, there's not enough people to do the work. Well, AI can certainly help, I think, free up folks from a lot of the more menial basic tasks to focus on some of the higher level, more creative, more advisory type of tasks. So I think it is an opportunity in an industry where construction projects are almost always over budget, delayed, cause a lot of frustration. Hopefully, sort of AI is going to be a way to design and build things more efficiently, more effectively, more resiliently, et cetera. So I think there's a lot of opportunity that we hope will come to fruition.
Josh, anything you want to add there?
No, I think Joe covered the waterfront there.
Pun
Well,
intended on the water, but
well, this is the time for you to look into your crystal ball here. Either of you have bold predictions for the future of what's coming next, or what markets or trends we should be watching out for?
I'll go first. Joe sort of hit on it there, and it has to do with the impact of AI and technology on our space that everyone keeps talking about. We're one of the last industries to be disrupted by technology. We're still fairly antiquated in the way we do things in the engineering space and consulting space. Um, but my prediction is not that AI and digital will replace humans or suddenly we're going to start selling software. It is what Joe just described, that AI and digital will very soon replace the menial tasks of our day-to-day job in this industry. And because it will suddenly become far more efficient and less time consuming to do work, the old school way of billing time and material, right, the T&M basis upon which most firms bill their clients, will no longer become a profitable endeavor because you're really spending a quarter or maybe a tenth of the time doing what you used to do. So my kind of big prediction is that technology and AI will force us into value pricing, but not valuing the technology, not valuing the software, which I think a lot of people get hung up on. It's that it will force us to truly value ourselves. It will force us to
Mm.
reprice and revalue the services that we provide as an industry. And so I mean, I'm hoping, I guess I'm predicting that AI and digital will force us into, to what Joe said, better pricing, better compensation, to make us the most valuable industry in that regard.
and I think the other sort of prediction, and it's maybe not that original, is M&A is here to stay. I think we're going to continue to see a lot of activity, and that's going to create winners and losers, right? Because it creates change. So there's going to be new firms that come up that become leaders, and then there's going to be some firms that may lag behind that haven't had as good a growth. If your competitor is out there sort of eating your lunch on M&A, so I think it will kind of continue to shape up the industry landscape. And I think the other point is that historically this industry had extremely low barriers to entry. Anyone could just take their laptop, their PE license, go to their 5 best relationships, give me some work, have a one man, one woman shop and start a business. If what we're thinking about technology and AI becomes a bigger issue, it's going to be expensive. You're no longer just going to be selling your labor. And if you don't have the capital or an ability to sort of invest in those tools, it may be more difficult to compete. So I think historically there haven't been many advantages of scale in this business because an engineer's cost is the same, whether you have 1, 10, 100, or a million. But AI and technology can change the dynamic and may give an advantage to firms that are better capitalized or have more scale or more profit to sort of reinvest in these things.
Well, gents, it's been great having you on the show today and getting caught up. Any listeners who are wondering about how to get their corporate finances straight or thinking about M&A, how can they learn more about AEC Advisors and connect with each of you online?
I guess go to acadvisors.com, Joe. We're not on like
Send us
social
an
media.
email,
We're
give us a
pretty
phone
bad.
call. We'll respond. Don't worry.
Please, we have a website that you know very well, Josh, and our information's on there, and we hope to hear from you.
Well, we'll be sure and link to all of that good stuff in the show notes and everywhere you find this show. Gentlemen, it's been a pleasure. Thanks again for being on the show.
Thanks for the opportunity.
Thanks for having us, Josh.
We'll talk to you next time.
Thank you for joining us today on the Bold Brand Show. For all of today's show notes and links to our sponsors, head over to boldbrand.show. Be sure to subscribe to our email newsletter where I'll update you on the latest episodes and other exciting things happening at Bold Brand. If you liked today's episode, do me a favor and share this episode with a colleague. Over at boldbrand.show, you can subscribe on Apple Podcasts, Spotify, and everywhere you get your podcasts, including YouTube, where you can watch full versions of each episode and join the conversation by commenting below. The Bold Brand Show is produced by yours truly, Josh Miles, and is a product of Bold Brand LLC, a branding and video agency for AEC firms based in Denver, Colorado. Visit boldbrand.com to learn more, or hit that orange button up top to schedule a time to chat about your branding or video project. Catch us next time where we chat with another bold innovator in the AEC industry. Thanks for listening. We'll see you next time.